Before we get to today's picks, I want to clarify something. I have noticed queries about why I've begun discussing stock fundamentals, news, and other non-technical details in these daily videos, despite this channel's focus on quantitative trading. Let me clarify, our algorithm for selecting daily oversold stocks established in 2019 remains unchanged. So why the new layer of commentary? The answer lies in a blend of curiosity and a deeper search for understanding. Over the years, I have always wondered about the stories behind the stocks picked by our algorithm. How do these selections, which we might only hold for 24 hours, fit into the broader market narrative? What can they tell us about market behaviors and trends? I have always seen each of our daily picks as a character. This exploration stems from a desire to delve deeper into the characters behind our daily picks. For years, I have been eager to understand the context around these daily picks, their dynamics at play, and the factors influencing these picks. It's about reverse engineering these picks through a conventional analysis lens. By exploring fundamentals and news, I aim to learn more about my daily picks and, in the process, video journal it. The goal is to satisfy my curiosity, offer a richer view of market dynamics, and who knows, potentially uncover insights and patterns that could inform new strategies when we do a retrospective at some point. And by sharing it with my followers, I aim to foster a community of learning and exploration. I hope this reassures you that our commitment to our quantitative foundation is unwavering. Today's pick number 1 is CRBU. Caribou Biosciences Inc. is a clinical stage biopharmaceutical company that develops genome-edited allogeneic cell therapies for the treatment of cancer. Caribou Biosciences is based in Berkeley, California. CRBU operates within the medical, biomedical, and genetics industry, a sector ranked 80th out of 252 industries, according to Zacks Investment Research. Today, Caribou Biosciences saw its stock price drop following the announcement of a pause in the development of CBO20, one of its cell therapy programs. This decision raised questions about the company's future plans and the viability of its product pipeline, leading to a decline in investor confidence. For the last quarter of the year, Caribou reported a wider loss than expected, with the decrease in revenue and an increase in research and development costs. These financial results did not meet analyst expectations, further impacting the stock value. The pause of the CBO20 program is a significant concern for investors. In the biotech industry, the progress and potential of clinical programs significantly influence stock performance. Although Caribou is redirecting its focus towards other promising therapies, the uncertainty surrounding clinical trials and the development of treatments like CBO10 and CBO11 adds to investor skepticism. Despite these challenges, Caribou has a robust financial standing, with enough cash to support its operations into early 2026. This is bolstered by a $25 million investment from Pfizer, indicating some level of confidence in Caribou's pipeline. The market for CAR-T therapies is competitive, and anticipation for Caribou's clinical data releases in 2024 could influence perceptions of the stock's current valuation. Understanding the dynamics of biotech investing is crucial, especially for those new to the sector. The fluctuating stock prices reflect not only the company's immediate financial health, but also investor reactions to strategic decisions and the speculative nature of biotech research and development. This situation highlights the importance of a balanced approach when considering investments in the biotech sector, taking into account both the risks and potential rewards. Today's pick number two is AMLX. Amylyx Pharmaceuticals Inc. is a clinical stage pharmaceutical company. It focuses on developing a novel therapeutic for amyotrophic lateral sclerosis and other neurodegenerative diseases. Amylyx Pharmaceuticals is based in Cambridge, Massachusetts. AMLX operates within the medical drugs industry, a sector ranked 88th out of 252 industries according to Zacks Investment Research. AMLX has been experiencing significant volatility and a sharp decline in price, mainly due to the failure of its late stage ALS trial for the drug Relyvrio. This event has caused regarding the future of the drug's market availability, leading the company to pause all promotions of Relyvrio. The fallout from this development has had a profound impact on investor sentiment and the stock's valuation, contributing to the perception of it being oversold. Moreover, the stock's dramatic drop can be attributed to broader market reactions to the trial's outcome as investors reassess the company's future revenue potential and growth prospects. Amylyx's decision regarding the continuation or withdrawal of Relyvrio from the market will be crucial in determining its financial health and operational focus moving forward. Investors and analysts are closely watching the company's next steps, including its exploration of potential paths forward and its efforts to understand the implications of the Phoenix trial results more deeply. The situation underscores the high risk nature of investing in biopharmaceutical companies, especially those dependent on the success of key drug trials. Today's pick number three is LUV. Southwest Airlines is a passenger airline providing scheduled air transportation in the United States and select near international markets. Southwest Airlines operates within the transportation airline industry, a sector ranked 92nd out of 252 industries according to Zacks Investment Research. When we say Southwest Airlines stock is oversold, it means a lot of people have sold their shares recently, causing the price to drop more than it might deserve based on the company's actual performance and future prospects. Here's why this is happening and what it means. 1. Boeing delivery delays. A big reason for the recent sell-off is due to delays in receiving new airplanes from Boeing. Southwest was expecting these planes to expand its services and replace older ones. Without these new planes, Southwest can't grow as planned next year, which has made some investors nervous and led them to sell their shares. 2. Market reaction. Sometimes the stock market reacts strongly to news, whether good or bad. In this case, the news about the Boeing delays led to a sharp drop in Southwest's stock price. This kind of reaction might seem like an immediate judgment on the company's future, but it's more about investors' quick decisions rather than a thorough evaluation of Southwest's long-term health. 3. Social media sentiment. On social media, you'll see a mix of opinions. Some people think the stock price drop is an overreaction and see it as a chance to buy shares at a lower price, expecting the company will bounce back. Others are more cautious, worried about the near-term challenges Southwest faces. 4. Operational challenges. Airlines are dealing with several tough issues right now, like rising fuel costs and changing travel demand because of the pandemic. These challenges can scare off investors, leading to more selling and a lower stock price. 5. Positive long-term outlook. Despite these challenges, many believe Southwest Airlines has strong fundamentals. This includes a loyal customer base and a track record of managing its business well. They argue that the current problems are temporary and that Southwest is in a good position to recover as the situation with Boeing is resolved and the travel industry gets back to normal. In essence, the term oversold in this context indicates a temporary dip in Southwest Airlines stock price, driven by recent challenges and market reactions, rather than a decline in the company's actual value or performance over the long term. Today's pick number 4 is BITI. To grasp why BITI might be seen as oversold, it's crucial to understand its inverse relationship with Bitcoin. BITI's value is designed to fall as Bitcoin's price climbs. With Bitcoin currently experiencing a bullish phase driven by heightened institutional investment, broader adoption, and favorable economic conditions for cryptocurrencies, its price has seen significant upticks. This bullish Bitcoin scenario contributes to reduced demand for an ETF like BITI, which benefits from Bitcoin's downturns. Bitcoin's recent surge is underscored by record high futures, open interest, and a market cap leap to 1.4 trillion, surpassing silver, signaling robust market participation and investor interest. This positive trend directly impacts BITI, potentially leading to its oversold status as market participants increasingly favor assets that gain from Bitcoin's rise over those betting against it. The bullish sentiment in the cryptocurrency market, especially for Bitcoin, is bolstered by factors such as MicroStrategy's Michael Saylor's belief in Bitcoin eclipsing gold in value and a more Bitcoin friendly stance from Donald Trump. Additionally, the crypto funds have recorded a weekly inflow surge to $2.7 billion, reflecting the market's optimistic outlook and anticipation of continued Bitcoin gains rather than declines. Hence, BITI's perceived oversold condition can be attributed to the ongoing enthusiasm and positive sentiment in the cryptocurrency market, particularly towards Bitcoin. Today's pick number 5 is UNFI, headquartered in Providence, Rhode Island. United Natural Foods Inc. is the leading distributor of natural, organic, and specialty food and non-food products in the US and Canada. The company offers approximately 250,000 products consisting of national, regional, and private label brands grouped into the following main product categories: grocery and general merchandise, perishables, frozen foods, wellness and personal care items, and bulk and food service products. United Natural Foods operates within the food miscellaneous industry, a sector ranked 93rd out of 252 industries, according to Zacks Investment Research. United Natural Foods Inc. is facing some tough times, and many believe its stock is oversold. Here's a look at what's happening. 1. Profitability concerns. Over the last decade, UNFI's ability to make money has been shrinking. Specifically, their profit margin, basically how much money they make after paying for goods and other costs, dropped significantly. This situation suggests the company isn't making as much profit from its sales as it used to. 2. Supply chain and inflation. Recently, UNFI reported a big drop in their earnings compared to what was expected. This drop was due to ongoing problems with supply chains, the process of getting products from the manufacturer to the seller, and rising costs due to inflation. These issues made it hard for UNFI to manage its costs effectively, hurting its bottom line. 3. Market reaction. After announcing these results, UNFI's stock price took a major hit, falling up to 35% in one day. This dramatic drop indicates that investors are worried about the company's future profitability and its ability to deal with ongoing supply chain and inflation challenges. Moreover, UNFI pulling back on its financial forecasts added to these concerns, making the stock less appealing to investors. In essence, UNFI is currently navigating through a storm of operational challenges and market pressures. These difficulties have led to a decrease in confidence among investors, contributing to the perception that UNFI's stock is oversold. However, it's also suggested that if UNFI can address these issues effectively, there could be potential for recovery and growth in the future.